Good afternoon and welcome to episode 39, Undaunted Sunnyman. Good afternoon to you, Huawei.
Good afternoon, Mark.
Thank you, Huawei, for making it. And to our loyal 10 listeners, thank you guys for tuning in. I hope everyone is just doing fine this week. It's been a good week. How's your week so far, Huawei?
It's been good. It's nice and sunny here in East Texas.
All right, finally we're out of the winter weather and we're now in the spring, right, Huawei? The
Yes,
spring
it is.
season.
Spring. Flowers are out.
Yes. Well, for our new listeners, this is your host, Mark Yu,
Bobby Santos.
and welcome to the Mark Yu and Huawei show. So, just a disclosure before we proceed, this show is made for sharing for information purposes only, not to be considered investment advice. Me and Huawei are both physical therapists here in the USA. We record once a week. We both of us we have the same passion and interest in researching and investing our hard-earned money in the stock market. For our listeners, you are in for a treat as we will reveal our portfolio positions come later on this episode. To our co-workers in the medical field, thank you guys for your hard work. And for those who have missed our previous episodes, episode 38, you can feel free to listen to it. We discussed there the weekly stock market sentiments and fund flows, the sell-off in bonds, all-time high in commodity sentiment, and the FANG stocks valuation. We also had our rolled clip segment, which include Wedbush Dan Ives and Morgan Stanley's Mike Wilson. So for this episode, sorry about that. For this episode, we're gonna start off with a fresh from the oven article that was just published a little bit, few minutes ago. It's from CNBC. Again, the 2-year Treasury yield tops 10-year rate, which is considered a yield curve inversion. So what do we think about this, Huawei? It's all over the news. So what do you think about this yield curve inversion?
So that's like on the headlines. If you're in the stock market, that's something that people are always talking about, the yield curve inversion.
Mm-hmm.
So historically, it marks a recession. It's a signal for a recession.
Mm-hmm.
But there have been some research and debate against that. But there's a correlation. They say that 22 out of the 29 recessions were marked by an inversion of the yield curve, which is basically your 2-year and 10-year treasury yields.
Right. So for listeners who are not familiar, so treasuries are like government bonds which investors buy and try to keep until its maturity or until the time for its investment is over. So for 2 years, obviously is shorter time period. 10 years, you have to wait 10 years and then get your interest, your coupons every year, and then you get to um, claim your original investment after the 10th year. So basically, in a normal yield curve, supposedly 2-year treasury yield should be lower, 10 years should be higher. But now it looks like it has inverted, basically meaning people are buying more. I'm not buying more, but yeah, people are not sure about the current situation, meaning 2 years, with 2 years on out. So they're kind of like buying more or investing more money in the 10 years. So leading into more demand on the latter end, resulting into lower yield because people are putting their money far more ahead of time compared to the 2-year treasury yield. So as a result, the yield curve has inverted, and like what we said, it has occurred months. How many months would you say, Huawei, depending on the history, prior to recession?
Well, according to Fidelity,
Mm-hmm.
it's like between 8 to 22 months.
Mm-hmm.
It's a signal that between 8 to 22 months from the inversion that there would be a likely recession.
Right. So it's not just automatically like, oh, we're now in a recession. So nothing to fear, I would say, right now at this point in time. But definitely, it's a definitely a warning sign that we need to take a look closer into and observe
Mhm.
how we position our portfolio in the coming years or months.
It, it's just a measure of risk.
Yep. So at this point in time, we're gonna jump on to the next slide. This is a Bloomberg article that we just took a snippet of. It says, at this closing, today is March 31st. So believe it or not, we're through with the first quarter of 2022. Finally,
Yes.
what
Yes,
an eventful ride.
and
Mhm.
the indexes well, Nasdaq was up for this month.
Yes, it has quite recovered, as we're going to see in a little bit. So, according to Bloomberg, stocks sink to first quarterly loss in 2 years. So, we're now at negative territory since the COVID lockdown of 2020. Um, Another slide here says losing 5% was the best you could do in stocks and bonds this quarter. So, if your portfolio is up 0.1%, congrats to you.
Mhm.
Because the best you could have done, if you're very conservative in a model of 60-40 portfolio, meaning 60% invested in stocks, 40% in bonds, you probably are down or negative. And according to Bloomberg, losing 5% was the best you can do. I hope not everyone has lost 5% in their portfolio this first quarter. So for
I
our
hope so
weekly
too.
yes. And for a weekly sentiment, American Association of Individual Investors, they have updated their survey as of yesterday, 3:30. Bullish sentiment is at 31.9% compared to last week's 32.8%. Not much, quite a difference. Whereas people are getting more on the neutral bandwagon from 31.7 last week. Neutral polls came up to 40.6% this week, and a lot less people are now bearish. From 35 bearish sentiment, we're down to 27.5% bearish at this point in time. Fear and greed sentiment also reflects that people are more neutral at 51, whereas a week ago we're at 46, whereas a month ago we're at 16. Extreme fear, like what we said, Nasdaq has bounced for the past 4 weeks. If we're going to take a look at Nasdaq, it is definitely the outperforming index compared to S&P 500 and Dow Jones. Nasdaq is up 5.45% for the past month, followed by S&P 500's 4%, Dow Jones at 2.29%. But since the start of the year, still, Nasdaq is the worst performing index. Could this be a signal of a turnaround, Huawei? What do you think?
Well, it's hard to tell, but the situation is still fragile.
Mm-hmm.
You still have the Eastern Europe war, Russia and Ukraine. You still
Right.
have the oil crisis.
Mm-hmm.
Um, so we'll have to wait and see.
Right. And going back to the first slide that we took a snippet of, it's indicated that the Putin is now asking for its customers to pay in rubles because they don't have access to their overseas dollar investments, so they cannot really convert the money that's coming in dollars at this point in time because they're shut out of the global economy because of these ongoing geopolitical occurrence. So we'll see if I read that it's going to be implemented first thing tomorrow. So I don't know if that's a serious indication or something that we need to keep a close eye on, since tomorrow is a
Mhm.
trading day as well. It's
I,
Friday, so
yeah, I
the
think
week doesn't end.
yeah, I
Mhm,
think we need to keep a close eye on that.
mhm,
According to Bloomberg today, as I
mhm.
was watching, um, there's news that they reverted back to accepting euros.
Oh, okay.
So
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 that's
we'll just
good.
have to keep posted on that
Hmm.
because that will kind of change some of the financial structures as
Right.
this war goes along.
Right. And for next slide is the volatility index, the VIX. So for the past 5 days, it's been falling -5%. But as you can see here from March 29th, a couple of days ago, until today, Thursday, volatility is slowly creeping back up. As today, I think we ended in the red. Markets are down today. So volatility for the Nasdaq as well. Well, Nasdaq a little bit less bouncy, as I would like to say that.
Mhm.
term compared to the volatility for the S&P 500. Volatility of Nasdaq is down negative 3% since the start of the week.
And that reflects its bounce this past couple of weeks. Bounce up.
It's been a steady bounce, except for today at least, because it went down in negative today. Safe haven demand exposes that investors are still greedy at this point in time. Stock price breadth, this is the McClellan volume summation, indicates the advancing and declining volume of the New York Stock Exchange. So it looks like for now it's being indicated as extreme greed. So some sort of a bullish sentiment there. So this is an article from Seeking Alpha that we had took a snippet of. It says here, despite an upward shift in the Treasury yield curve, investor favored Treasury funds in March so far. So this is the tracking, how we keep track of fund flows. So volatile fund flows, definitely. So as we can see here, historically, investors generally choose money market funds during times of equity and fixed income or bonds volatility. At this point in time, though, interestingly, investors were withdrawing money from money market funds, or at least for this month. For this week alone, investors withdrew nearly $3 billion for this week, and they have withdrawn $158 billion from money market since the start of the year. So it's quite interesting. Meanwhile, the investors are putting their money more into, looks like, both large cap ETFs and large cap conventional funds. So for large cap ETFs, investors poured in $5.4 billion this week. Whereas for large cap conventional funds, they poured $493 million. So it's quite interesting where, I guess retail investors are buying the dip.
Yes, they are. And
So,
they're going for the large cap.
Yes, sir. Growth
Google,
large cap is up
Apple.
$5.91 billion in inflows for the week that ended in March 23rd. And growth value, yep, mid cap and energy, interestingly, saw some outflows for the week that ended in March 23rd. These are for ETFs.
Yeah,
ETF
probably
fund
profit
flows.
taking
Mhm.
from energy.
Yep, that may not be too far. Yeah, that's true. And for today, each and every sector down. Widest underperformer is consumer cyclical, followed by communication services, followed by financials, and always technology is always seeing red. For the past week, the outperforming sector is utilities, followed by real estate, followed by consumer defensive, followed by Wall Street favorite sector, healthcare. Underperforming for the past 5 days is financials and communication services. And since the start of this year, obviously, best performing sector is still energy, 29.73%, followed by basic materials, 7.23%, utilities, 3.69%. The rest of the sectors are in the red. Technology is the worst performing sector at negative 11.61%, followed by consumer cyclical at 11.51%. So hopefully the recent bounce this month for the past 4 weeks would indicate that the technologies were gaining some investor interest and bounce back.
Yeah, the prices are low, so they're buying the dip.
Buy the dip. And for the put call ratio, the tail that wags dog, we're seeing some less and less put option trading compared to call ratio. So people or investor are getting a little bit more bullish, as also reflected in our sentiments guide earlier in this podcast recording, like when we take a look at the American Association sentiment and overall fear and greed index. So
Mhm.
for the miscellaneous, it says here from Bloomberg, stock bull market intact amid worst quarter since 2020. So UBS, one of the Wall Street banks, says that bull market is still intact. The risk reward from here is fairly balanced. And further on, it says Federal Reserve more likely than not to manage soft landing. So I guess UBS is still on that camp that the Federal Reserve's got the investors back and will support the stock market for the long term.
Mhm. They will remain accommodative for sure,
Mhm.
but they will raise the interest for sure.
Right. I saw some posts yesterday that they're expecting now 50 basis points on the next two federal meetings, resulting into possible 1% hike overall. So this is a graph from Reuters, U.S. Treasury yield curve inverts. So interestingly, it happened for a split second or split minute in
Mhm.
Tuesday, the inversion. It didn't stay there for long and it bounced back up. So it says here, a quote from Reuters article, the US curve has inverted before each recession since 1955, with the recession following between 6 and 24 months, according to a 2018 report by the Federal Reserve Bank of San Francisco. According to the article, it offered a false signal just once in that time. The lag between curve inversion in the start of a recession has averaged about 22 months, but has a range of 6 to 36 months in the last 6 recessions. So 6 to 36 months is quite a wide range of, time period. So
Mhm.
it's better to be prepared regardless. As we take a closer look into some of these indicators too, further in this podcast. So one thing that we need to we recently discovered is the financing part of things. So mortgage rates is now 4.65%, highest since 2019, and mortgage refinancing has been affected. According to this article from CNBC, mortgage refinancing or refinance demand plunges 60%. So that's not a good indicator in terms of the housing finance. So people who have houses now who have locked in very low rates, I guess it doesn't really make sense if you're going to refinance at a higher rate, unless you just
Mhm.
want to punish yourself. So it doesn't make sense at this point in time. So clearly, this is, not a red flag, but obviously, who would like to refinance at a higher rate? One thing that I can look or think of who would be greatly affected on this are people who are like the fixer upper type of investor, where they buy a property, fix it up, and then refinance it to cash out some money. At higher interest rate, it may not make sense because of higher monthly payments moving forward. Well, we'll see. U.S. consumer confidence rises for the first time this year in February, interestingly. But inflation in Ukraine still big worries. So this is data that was just published a couple of days ago. So despite the ongoing geopolitical happening there overseas and the rising inflation at the highest in 40 years, consumer confidence bounced back up by 2 points from 105 in January to 107 in February. So I guess U.S. consumers are still resilient at this point in time. Um, Interestingly, this is just a jobs report from ADP released yesterday. Companies added 455,000 jobs, slightly more than expected. I guess we're gonna see the report tomorrow, right, Wabi, from the government, because it's the first Friday of the month, technically April
Oh,
1st.
okay. Yeah, the
So
JOLTS report.
yes, so usually it's being released first Friday of the month, and incidentally, tomorrow is the first day of April. So hopefully we get the report, and it all hopefully it'll reflect what ADP has reported just yesterday. Meanwhile, personal savings rate has not been the lowest since December 2013. So people are probably, you know, using more of their savings at this point in time because of higher inflation and possibly dipping into credit card consumption. What do you think, Wawi, at this point in time?
Um, I don't know for sure. I haven't been tracking that, but you should expect more buying this spring. You know, people are going out, more traveling, more staying in hotels.
Mhm.
Um, Hospitality should go up, so you should see a rise in spending when it comes to going out to eat
Right,
and going to theme parks and stuff.
right. Yeah, and as reflected to the ATB jobs report, leisure sector has been favoring more hiring at this point in time. I guess we'll
One
see.
thing,
Mhm.
one thing that got into my radar today, Mark, is like gambling, right?
Uh-huh.
Casino and sports betting. Those type of activities are going up as well.
Uh-huh. So I guess
Mhm.
it's rampant. I think I saw a clip where even advertising, basing it on Super Bowl advertisements, gambling apps such as DraftKings and stuff, they've
Mhm.
been advertising very hard on. I think they multiplied their expenses from little less 200 million to over 700 million just for advertisements, trying to get more customers to try their luck at gambling.
Mhm. So
So
that's called gambling, but I guess in the industry sector, we should call it gaming.
gaming, right? So now with the highly enriched, knowledgeable retail investors in Robinhood and other brokerage. So I guess these software companies is trying to at least expand their business to new customers. As you've said, gambling might be a growing sector, obviously at this point in time.
With regards to the exchanges like Robinhood and stuff, I come to my radar. Yeah, I think last night that FINRA is suggesting more reporting coming from this broker exchange to declare, certain activities by their retail investors.
Mhm.
So they're trying to see how competent their retail investors are. And there had been talks about education. Are they educating their retail investors? And they should report it. You know how skilled their retail investors are, how knowledgeable they are about
Mm,
the market.
right, because it's definitely it's hard. Well, it's not gonna be a totally negative for a company to have a customer who loses all his money gambling, but it'll be of benefit to everyone to know their risk tolerance at least, or to know where they're putting their money, and hopefully they
Mhm.
don't lose a lot by gambling. So this is just came in through the wires about half an hour ago. GameStop shares surge on plans for stock split.
Oh,
So I guess
wow.
right now it's up 15.68% after
Mhm.
hours after saying that they're gonna split their stock. I guess they're trying to ride that mania. Well,
Yeah, stock
it's not.
split mania.
Yes, not really a mania, I would say, but that kind of like trend at this point in time, which was initiated by Amazon, followed by Google, and now
Followed by
GameStop.
Tesla.
Oh, followed by Tesla and then GameStop. I don't know why GameStop all of a sudden wants to split their shares. Their shares are around 166, whereas if Amazon's going to split their shares, I think we talked about it. It should be around 180 or 250 a share. So at 166, why would you want to split your shares? But I guess the executive behind GameStop knows how to play Wall Street at this point in time. If you're
Yep.
going to look at the stock price of GameStop for the past week, it's up 19%. For the past month, it's up 40%. So we've been talking this, we've been sharing this information also as well in our Facebook Messenger group. And I've said probably maybe the meme mania is back. If you're gonna
Yes, it
take a look
is.
from March 14th, from a couple weeks ago until March 28th, GameStop stock has more than doubled, up 143%. So mania is being felt again, even with a broader sentiment that the market is just neutral at this point in time.
Yeah, if you're following Wall Street bets, you would see some of the guys talk about this happening.
Hmm. Yep. Wall Street Bets is back after hibernation. So another article that we just saw, U.S. corporate profits jumped 25% in 2021 to record high as economy rebounds from pandemic. So obviously, 2021 is a much better year than 2020. There's no, uh, you know, contraindication to that. Meanwhile, it's much better to participate or to take notice or keep a close eye on the guidance. So this is snippets from FactSet research guidance. So we're gonna take a look at guidance for the first quarter of this year. So which just ended technically calendar year. Where today is March 31st. So January 1st to March 31st. So for guidance, it says here by FactSet, highest number of S&P 500 companies issuing negative earnings per share guidance since the fourth quarter of 2019. So that's a little bit troublesome, but it could be, as expected. We locked down March of 2020. So for 2021 first quarter, the businesses have started reopening, vaccines are being provided. Daily news about how many percentage of population, US population has been vaccinated. So business has been opening slowly. But despite that, it could be just a slow ramp up. Despite that occurrence in first quarter of 2021, we are seeing a lot of companies now warning that their first quarter of 2022 will be a lot lower.
Yes.
So 95
And
companies, go ahead.
yes, and the common theme is um, because of raw material need um, and supply chain issues.
Inflation affects both ways, not just consumer, but also the companies that are producing these products. So according
Higher
to this,
costs.
yep, higher costs resulting to lower profits. According to FactSet, the percentage of companies issuing negative guidance, earnings per share guidance, is 69%, which is above the 5-year average of 60%. A little bit troublesome. For the year, according to this FactSet data, which was released a couple of days ago, still for sales or revenue, business growth, which is critical to see if a business is growing or not. The best sector, obviously, for this year is energy. We're seeing 21% growth, followed by consumer discretionary, which is gonna do about the same compared to last year, followed by real estate, followed by industrials, followed by information technology. The worst performing, or not worst performing, but the negative growing in sales, which means that they won't be generating any new business, is utilities, interestingly. Meanwhile, the slowest grower among the industries or sectors are banks, financials, despite the upcoming hike in rates. It's quite interesting, right, Maui?
Really, is that just a short-term forecast or
I think it's a CY calendar year. No, this is for the year,
mm,
for
I see.
sure. So despite the hike in rates, interestingly, banks, consumer staples, Wall Street favorite, healthcare, is among the group, among the sectors in the group that are going to be recording or expected to provide lower revenue growth compared to their other peers. For earnings growth for calendar year, believe it or not, financials are going to be the hardest hit this year. Interesting.
Wow.
negative 11.4% growth. I mean, that's not growth, loss. Yeah, negative 11.4% earnings loss for financials, followed by utilities at 2.2% growth earnings, followed by communication services, 2.2%. And obviously, the highest growth earners for this year, as expected, energy, followed by industrials, followed by consumer discretionary, info technology, real estate. For meantime, info technology has been quite near the upper border of this growth aspect.
Mhm.
So um, compared to the Wall Street favorite healthcare sector, we're not seeing as much growth compared to yeah energy or infotech. Infotech and energy looks like, along with industrials, looks like the safer bet for the rest of the year. So
I
this
guess they're all factoring in inflation is the main factor here
right.
for that forecast.
hmm Looks like, as consumer services and staples are in the lower end of the growth part. So these are handpicked by FactSet top 10, uh, you know, between Wall Street target price and closing price. So they're looking at the most undervalued company in S&P 500. This by no means is not an investment recommendation, but I guess among the S&P 500, General Motors sees a possible 69% upside compared to its Wall Street price target, followed by Bath and Body, 69%, 68.7%, PayPal, 61.6% upside. So I'm just gonna say the target price for listeners who are listening over the phone or podcasts wise and that doesn't have access to our YouTube channel. So General Motors target price is $75 a share. Bath and Body, $84 a share. PayPal Holdings target is $187 a share. Under Armour, $25. Stanley Black and Decker, $221 a share. For the bottom five, according to FactSet, the most companies, the companies in the S&P 500 that has the most downside from here is number one is Nucor Corporation. This is a utility company. They're seeing a possible 18.8% drop compared to its Wall Street target price. Archer Daniels Midland, negative 17% with a target price of $75. Mosaic Company sees a negative 11% downside to $61 a share. CF Industries sees a negative 10.7% downside or $95 a share. Newmont Corporation sees negative 10.5%, $70 a share. Interestingly, Occidental Petroleum, a Warren Buffett favorite, sees a negative 10% downside, target price of $52 a share. All right, so we're going to take a look at Huawei's portfolio at this point in time. I guess Huawei probably enlighten us with your portfolio at this point in time.
So I've been investing in this last over 3 years.
Mm-hmm.
So this is the top performing stocks over my portfolios that I have. I have 5 active portfolios. So I combined all of them into uh, one screenshot, and so you'll see some of them are redundant, but you will see how they performed over those 3 years. Some of them I have held for just a little less than 1 year.
Wow.
So, but you would probably be able to find out when I got them because I included the cost basis for
Mm-hmm.
each of these shares.
Oh, these are really good. Tesla, you bought at $99 a share, whereas right now it's $1,000 a share. 982 gains,
Mhm.
982% gains.
Well, it could have
Incredible.
been higher. It could have been higher because
Mhm.
Tesla was at $50 when I first bought it, and then sold
Oh,
it for a profit, and then went back and I just went with my conviction, And
Mm-hmm.
so I was, so this would be reflective, I guess, probably reflective of my conviction.
Mm-hmm.
These stocks that are in here, I studied and then I said, okay, I'm gonna go for it, and then went for it.
Nice. Well, quite a.
Now there
Well,
there are some that are still like in the like new company investments that I bought that are running like 60% below what I got
mhm.
them. But those are also conviction stocks, and I'm just like, and mostly technology, and I'm just thinking maybe in 3 to 5 years, they should go up as well.
Mhm. Well, that's really good, Maui. As long as you have that investor um, discipline and not just going in and out of stocks. So I could also see here, Maui, you also have some ETFs
Mhm.
like Fidelity's 500 and Vanguard.
Yes, so the second screenshot that you're scrolling down right now shows the total cash volume or the current value that these holdings have. And as you can see, my highest concentration is on Tesla, followed by several different forms of the S&P 500.
Mm-hmm.
Some are growth, S&P 500, and some are ETF S&P 500, and some are mutual fund S&P 500 index. But
Mm.
guess what? Amazon is in there
You got Amazon here.
and
You got
Walmart.
Walmart, which are good buys. You're up quite a good amount, 20%. Even with the ETFs, you're up quite a good amount, almost more than 40% on average. That's really
Mhm.
impressive, Huawei.
Thank you,
So I,
Mark.
I guess as long as you keep, steady the ship and, just be aware of the possible buying opportunities down the road
Mhm.
and, stay disciplined and not act like, how do you call it, erratically when things start heading down. Instead, try to see it as an opportunity. Then you may probably end up with what Huawei has in
Yes.
currently in terms of his portfolio gains, which is really admirable. For me, I guess I only have here the top 10 in my portfolio. Currently, I haven't added to any of them. I don't think I've added for the last couple of months, honestly. But because of the energy outperforming, my
Mhm.
Chevron and Exxon Holdings coming out of nowhere, I think they were on my 13th and 15th position of my top 100 or top 20 portfolio.
Mhm.
Chevron now is way up there. It's my number one holding, um, followed by Google, followed by ExxonMobil, and the rest kind of were similar. Where we picked up a couple of months ago when I first shared the portfolio. Followed by Apple, Walmart, J.P. Morgan, Amazon, Costco, Meta Platforms. Oh yeah, so I bought a little bit more of Meta Platforms since it came crashing down.
Mhm.
And then Nvidia. So some tech, some a bank, J.P. Morgan, and a couple of energy plays in the portfolio.
Well, those are real solid companies, Mark, and
Mhm.
they're built like ships.
Thank you.
So, and very reliable companies. They have been around for many years.
Right. Yeah, my
So,
goal right now is probably once the split happens, especially for Google and Amazon, I might be probably buying buy more shares instead of like saving a lot. Because right now I think Amazon is almost $3,000, right? And Alphabet is about 2,000. So it takes quite a chunk if you're gonna buy those shares all at once. So
mhm.
we'll see. Hopefully it
Well,
helps average down. Mhm.
yeah, when they split, then it will allow retail investors like us to be able to afford a full share.
Right.
And with some of the history that we've seen with stock splits, it has raised the stock price after a stock split. So
Mhm.
let's hope that happens again for those that are investing in these type of companies.
Yep. We're soon gonna see. So, an article from Seeking Alpha: should investors be worried about the yield curve inversion? So,
Well, I'm not.
hopefully, our listeners too are not that worried or terrified, because there's no way of predicting when it'll happen. We can only see signs. For example,
Mhm,
labor numbers. So, labor numbers can actually be a lagging factor already. Unemployment could
mhm,
be a lagging factor. The NBER, the National Bureau of Economic Research, they came out, in fact, we witnessed it. They came out with their recession announcement
mhm,
months after the COVID lockdown. So everything is working on a delayed manner. So,
mhm.
well, according to this article, according to the fund manager at PIMCO, quote unquote, there's reason to believe that this time around, yield curve inversion may not be as good of an indicator at, as it has been in the past, particularly given the enormous amount of quantitative easing undertaken by global central banks. So he's not into that camp that we should all be worried because of the amount of free money, not free money, but quantitative easing that does.
Well, I
Not
think the main thing for not being worried would be, do you have an emergency fund?
right.
And that's something that investors should think when it comes to times of volatility.
Mm,
Just have peace in knowing that you have saved enough just in case something happens, and so
right,
you have something in your bank or in your investment that you are gonna be able to pull out.
right.
So it pays to be liquid too, right?
True. 100% agree. So now we're gonna jump on our roll the clip segment. Unfortunately, we weren't able to find any Tom Lee interviews nor Morgan Stanley interviews. Well, this one is a Morgan Stanley.
Mm-hmm.
They discussed the curve inversion and credit. So this was just recorded this morning, March 31st, with 1,400 views. And let's roll the clip.
What does solid growth mean for my 2022?
Yeah, thanks. Good morning, Tom. Great to be here with you and everybody else. So solid growth to us means that growth is lower than where it was in 2021, but 2021 was a very high bar. That was extremely strong global growth. And 2022, we think, will still look pretty reasonable by the standards of the last 12 years, that we're still looking at, U.S. GDP growing around 4% this year. And even though we think we have a very disappointing first quarter in China, ultimately the full year growth we think will still be pretty reasonable, and that Chinese growth will reaccelerate as the year goes on. So when we're thinking about stagflation, I think we're thinking about a year much more like 2005,
Oops.
where PMIs are decelerating, inflation is higher, policy is tightening, than something where growth is really falling off right now in terms of what the market needs to deal with.
Andrew, the research you put out recently is that we've priced in higher interest rates, but not the growth risks associated with it. Can you pour through the equity market for us and help us understand where you think that needs to be priced a little bit more?
Yeah, so I think this is where some of the debate around the yield curve, which I'm sure is something we are now going to be talking about for the next 6 months, is really interesting, because I think what the yield curve is discounting is higher odds of a growth slowdown next year, which we think is correct, and that certain asset classes are going to be more vulnerable to that than others. So, when we think about the overall equity market, when the yield curve inverts, it doesn't necessarily go down. In fact, it tends to keep rising after that inversion happens. The equity market's balancing. Yes, there's some greater risk of recession, but there's also a possibility that things continue on for another 12, 18, 24 months. But assets that tend to be more growth sensitive, something like U.S. high yield, that tends to see a pretty bad risk reward when the curve inverts, when the odds of a recession are rising, and that starts to really underperform after yield curve inversion. So we think that favors somewhat more defensive positioning within U.S. equities, things like healthcare, utilities. We think that favors investment grade over high yield within U.S. credit. And then some of the non-U.S. developed markets we think could be in a better place, a marginally better place, because the financial conditions there are easier, policy is under less pressure to tighten in Europe and Japan.
Andrew, I find the banks call fascinating at the moment. Betsy Grosick made a move early this week. Can you walk me through how you and the team are thinking about the financials?
Yeah, so we downgraded financials from overweight, which had been a favored sector for a while, down to equal weight. And the reason for that is a function of both. We've had a very large interest rate move that had helped the sector, but also financials, as you start to get later in the cycle, have to balance both loan growth that is often still strong. Banks continue to lend even after the yield curve flattens, with the market often thinking, well, if the odds of a recession are rising, we need to price in a higher risk premium around higher loan losses, 18, 24 months out. So, we think the sector's risk reward is now a lot more balanced here, again, as those two factors are competing against each other, and after we've had a pretty large rate move. And so that leaves us more balanced and looking to reassess.
Andrew, where do long bonds sit in your portfolio, given the sell-off that we've seen to date and given the call that you have that we're in the same kind of environment longer term, even given this blip?
So I think that the backdrop favors a flatter and more inverted curve. That's very much the way that our interest rate strategists at Morgan Stanley are thinking about that. And that we could even have a dynamic where the 2-year rate continues to go up towards 3%, but the 30-year bond does not rise in yield from here. Maybe it even declines a couple of basis points. Again, as the market is looking at a very strong, we think, structural demand for longer term duration. And also as overall yields rise, the funding position of pension funds gets better. That increases the desire to buy long duration assets to defease those pension liabilities. So we think longer term investment grade bonds offer better value here than, say, high yield. We think some parts of the emerging market credit index will offer better value than, say, emerging market equities here, again, in part thanks to the longer duration of that index. And we certainly would put ourselves in the curve flattening, the long end outperforming camp.
Andrew, I know you've been building cash, and that Morgan Stanley's approach generally has been to hold a bigger portfolio of liquid assets. At what point, what signals are you looking for to shift that, to deploy more and to go more into risk?
Yeah, it's a great question. So one, I mean, the equity market has clearly rallied back very, very quickly and more quickly than we expected. So, certainly lower prices, but more specifically, a higher equity risk premium would be helpful. What we've seen is, in our measures, a real compression of the equity risk premium, a large richening of equities relative to bonds in a short period of time. I think more space opening up there would be helpful. I do think the investment case in Europe could be a lot cleaner if we saw somewhat more certainty around the direction of the conflict in Ukraine, and that could, I think,
It's going longer and longer. So I guess Huawei, he said to be more on healthcare. And what's the other one? Utilities. And they just downgraded financials.
Because of the risk of defaults.
Possible risk of defaults 12 or 24 months ahead. They have to significantly increase their loan loss provisions, which would affect, obviously, their earnings.
So what regarding default, have you heard some of the report about increasing like the mortgage to 40 years?
Oh, no, I haven't really. But
anyways, there's been some suggestion regarding that.
Like lengthening the time, the mortgage length.
Yeah, the length of the mortgage, lengthening it to 40 years, but there may not be a lot of takers because of the high interest.
Yeah, they're going to be, yeah, that's true.
The start of that loan.
It's going to be more payments coming out over time, and which is going to accumulate in terms of like expenses, or, instead of being able to finally complete your payouts for your house, it's going to be taking longer. But
well, it's the front end of that loan that's going to be horrible for the mortgage, mortgage buyer, right?
True.
Because the interest will be higher.
All right. Well, before we end the show, do you have any quote for the week for our listeners?
No, just stay steady and persevere.
That's a good enough quote. Stay steady and persevere. I think that's the role that we need to play with because it's hard to be flip floppy in this kind of market, especially now we're in the volatile end compared to last year's all-time high every other day or every single day. So
Yes.
yeah, and always be prepared, right?
Yes, Mark. You have to be.
All right. Well, Wowie, thank you so much for coming on this episode, listeners. That
Thank you,
does
Mark.
it. Thank you. You're welcome, sir. And if you have any questions, send it over to markuwawishow@gmail.com. And remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
Wawi Santos signing out.